What's up, Bat fam? Here we are on the charts. Now in this video I'm going to be talking about false breakouts, sell traps, buy traps, and an introduction to liquidity sweeps. This video is a continuation of the last video that I made. I'll have a little chapter come up to, if you have not watched it yet, you can quickly just click and watch it. However, we're going to be adding on to these concepts that I just introduced. So we're going to go to the BAT playbook here, and if you want access to this playbook, there is 8 scenarios so far, 8 pages, and I'm adding 2 more pages every single week. These take me a lot of time to make, about 1 hour to make one of these pages. So the examples we're going to be going over in this are, like I said, false breakouts, sell traps, and buy traps. So first we're going to start with the false breakouts, which also go hand in hand with sell traps and buy traps, and they're all going to be talked about. So first things first, we're going to look at the sell trap and buy trap scenario. Now we're looking at sell traps and buy traps near session highs and lows. Okay, so here's the illustrations I have. I know you guys can't read it, so I'm going to show you some examples. So we're going to go to gold here. Now this is some markups I have from the most recent pages I just made of breakout trading and impulse trading, and we're actually going to be going over some of these examples later, but not right now. So I'm going to clear this off. So first things first, we're going to go to an important area where buyers and sellers get faked out a lot, right? Where they assume breakout's going to happen and goes the other way. And here's a good example right here of a sell trap. False breakout, sell trap. And it did break out some, but it ended up reversing and creating a sell trap. So here we go, right here. We have something right in this area. So let's break this down. Right now we're on the 4-hour time frame. There's a previous lower high here and an area of resistance. So let's go down a bit lower. What do we see? We see a strong wick rejection right here from an area that it looked like it tried to break out from. Okay, let's go a bit lower. And you can recognize these things by the exhaustion, the wick rejections. In the last video I told you guys, the wick rejections, the exhaustion, that is almost always a guaranteed reversal sign or liquidity sweep. You know, if price is breaking out and continuing, it does not make these top wicks, these massive wicks, like here in this example right here where we're at, and over here, and you can even see more, you know, like right here. Okay, price does not continue in the direction that it is heading. When it makes these wicks, it's going the other way. All right, so what do we see here? When we see this large move, this build up of price to make a bullish move, but then this little minor trend line broke, this little uptrend line broke, that price is pushing off of, making higher highs and higher lows. That broke, made a low point, but it also trapped sellers here. Trapped sellers here thinking this is the top and that this move right here, that happened. This move, the sellers are thinking it was happening from right here. Okay, and yeah, all the signs are there. You had the bearish candles, the engulfings, lower time frame breakout structure. Yes, I agree. But remember in the last video I said that when these areas break, they come to retest a lot of the time. Well, this is the exact same thing. Price is coming back. It looks like a higher low is here. Looks like a higher high is trying to be formed. And then we get the strong projection for this solid downside move. This would be a false breakout, because if it was going to continue, we would have broke this high, right? Broke the previous high and then just continued up, like we did over here. Like we did for right here. And then we can see we also continued much higher in this move, right? So let's go over a few things. For this move to happen, it would need to have looked like it does on the right side. Okay, next, let's say you were in a buy on this. Let's say you got in down here on the low, targeting a higher high point. Stop loss below that point right here. There's 2 things that could have happened. You either would have got stopped out because you're trusting your analysis and the take profit to hit, or you would have got out of break even because price already moved a lot in your favor and you should be managing your trade that way. But let me put the stop loss back. Okay, so here we go, moved it back. We're going to go down to a lower time frame here. There's some things you need to recognize on the lower time frame when a breakout's going to happen or not happen. And in this example, this is when it doesn't break out, okay? You need to recognize a few things. Did not mean to add that. Right here. Obviously the exhaustion, as I keep saying, right? The wicks. But there is a certain candles, certain behaviors that happen in these areas that determine and will tell you that it's not working, that it's a false breakout, okay? We're going to the 3-minute time frame now. Look at this candle. This is one 3-minute candle, okay? Strong rejection. When you look at structure and you look at the other candles in certain areas, in other areas of the market, when they continue going higher, they don't do this. They don't break these little lower time frame structure points, okay? So this would be a higher low, you could call it. Higher low, higher high. If the trend is going to continue bullish, one, it would never have broken down like this. It wouldn't have done that, okay? Would need to have had to held this area, and you would have seen like a move off of here, rejection from the high, or a breakthrough and continue. Something like this. So the fact that you got this 3-minute candle that just completely took out everything like that. This one 3-minute candle took out the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 33 minutes of data in one 3-minute candle. So that should show you something changed. The market characteristics, the behavior is changing. The current behavior that you're looking at is changing. It's no longer bullish. Okay, I wouldn't do that. If you go to the 1 minute, same thing. One 1-minute candle just took out all that. This is minor lower time frame structure. It needs to hold this and create a higher low here, or from this black line and continue higher as such. I'm going to illustrate either like this, or you need to make a little minor pullback and continue. But that clearly didn't happen. So this is your indication that price is no longer going bullish, okay? So given that you have this lower time frame structure break, this is where you can look to take sells. Okay, so this is our buy setup. You see that there's a false breakout. You need to close this. And if you took these buys right here where I said we got in, you definitely should have already closed and got out, because you already caught a massive move from this point up to these highs is 200 pips almost 200 pips on this one move. Okay, that is a $20 move, a $19 movement. Okay, that's a really big move on gold. Next, you definitely should have been managing your risk, and you can see on these lower structure points on the 1 minute time frame areas, you can be trailing your stop loss at if you're in a profit below these candles. Okay, here's where your stop loss is. Move it up. Okay, you can move to here or below this candle. Once it broke, you would have been taken out in profit, and you wouldn't have secured as much as you had, but you still made money on the trade, and that's what matters. Okay, so it matters at the end of the day. So you see this false breakout, hopefully you got out, but if you didn't, you need to recognize these candles and how they're moving, and the behavior is what you're really paying attention to. And so you recognize these false breakouts. So that was a sell example. I'm sorry, that was a buy, a false breakout for a buy, which this is a sell. This trade setup now is a sell, but the example I was showing you was a false breakout for a buy. So now let's look for the exact opposite, a false breakout for a sell. Right here. Here we go. Same exact thing. Okay, so I'm going to mark out this little area with the zone. This could also be called a liquidity sweep. These wicks, retail trader knows them. We call them as fake outs or false breakouts, but they're also liquidity sweeps because they're sweeping liquidity. They're taking people's money. People have to lose. Money has to be taken for these bigger moves to happen, okay? So lots of people are losing money on these rejections. Lots of trades are being made, transactions are being made, panic selling, greed, all this is going on in these moments in time. So I'm going to go to the 1 hour. This wick that I have highlighted right here is this wick right here for this bullish move. So you can see there's liquidity sweep. This was liquidity sweep. It took out this highs, came up to here, retested, and then dropped back down. Same exact thing, except it took out the lows, and then now it's going back higher. So as you can see, false breakout to the downside. This is a sell trap, okay? So now, let's go here. The 5-minute time frame. So if you were taking sells, right? Like, okay, that's respecting this little area of resistance. I'm gonna draw with a little line right here, a little trend line. It's respecting this area. Okay, it overshot a little. Now it's gonna go down to make a lower low point. So you have your areas of structure marked. You have your lows down here. So we have our highs and our lows marked off for this current area. Going down to the 3 minute just to see more candle details. We're actually going to need to see a little more, but you can see this just completely flipped, and it would never do this if it was a sell, which indicates to me and to other traders as well that this is a false breakout, because if it was going to continue, we wouldn't have this exhaustion, and two, it would have been a clean break, right? It just would have went down, or had like a push and like a lower high, and then, you know, continuation, something like that. Okay, it would not have this type of exhaustion, this type of wick. So let's take a deeper look. The 1 minute time frame. I thought we would be able to see it on the 3 minute, but we cannot. So go into the 1 minute. See all this bearish pressure. You see this bearish price action. You're recognizing on the lower time frame that you can take sells. You see an engulfing. You see a lower high. You can take it right here. Okay. Stop loss above this high, and you're targeting this level of support or these lows. So let's just say you're targeting these lows, and let's take profit 1. And you're anticipating a lower low, so we'll have another risk to reward tool and target a lower low point, way lower, like down here. You're thinking 1635. Okay, on the higher time frame, let's zoom out, see where this is. Right here. You're targeting down here, thinking because this is where price broke before, there's an area of resistance, you could drag it down lower, even here. So where this major level, this major point is right here, okay? You're targeting 1632, 1634, around there. But price doesn't go down there, right? It rejected from right here. So you have your take profit 1, take profit 2. Okay, go back to the lower time frame on the 1 minute. So here, take profit 1 was hit, right? Hit the major lows, but we rejected. So in real time, you need to manage this trade appropriately. Obviously, when it starts breaking a certain point, and once it breaks its lows, like right here, these little lower time frame level support and structure. Once that is broken, stop loss to break even or even close if you want, because this was a pretty big move. You know, let's just say you got in at these highs right here, right at the lows. This was a 15 pip trade, so it's not too much, but that's a decent move. And then it dropped for 50 pips from your entry point right at support, and then take profit 1 was 70. Okay, so that's a pretty good trade to have gone in profit, and you shouldn't be letting those type of trades come back and take you out. So break even, take profit 1 was hit. You should definitely got out or secured a half, either one. I most likely would have closed all. Yeah, break even on this position too. So depending how you trade, if you're taking partials, close half here, this position, run at break even. They're both at the same price, but you're having two different targets, right? Take profit 1 and take profit 2, because you're trying to leave a runner and catch more profit. You know, it depends on what your strategy is, but doing that is very safe. Securing half and leaving the other half run to try and catch, you know, an additional, from where you closed, it'd be an additional 117 pips, 180 pips, roughly. I'm sorry, 120 pips. Yeah, so that's a big gain to potentially catch. So getting stepped out of break even isn't that bad in this situation on this position, not the ones that you already closed. So once you recognize this, you're taken out of the trade. There's two things that can happen. Either that's a reversal or it's coming back and trying to make a lower high. Either one, you need to watch for this, because this is a buy signal, okay? Once price does that and reverses, it most likely is going to come back. And this happens at session lows and session highs of the day, like Asia session, it gets swept, or London session, the higher low gets swept. So let's see what time this was. This is right at the start of New York session. So like I just said, right at the start and end of sessions, at the session highs and lows. And that was a 5 o'clock candle, which is the start of New York session. These lows right here were set during London. These are the London lows, okay? Then these are the London highs. So if the London high was just taken out, you should expect a higher low to be made, or the lows to get taken out, but it to be a fake out, okay, which is what happened. Look, a liquidity sweep is basically a fake out. It takes out the lows or highs and makes you think it's going one way and then gets smacked back the other way. And this happens day in and day out repeatedly to trap traders in and move the market. And this is what just happened. Broke London's lows, made you think it was going to go lower. False breakout, snapped right back in and broke out to the upside. Okay. So this is an introduction to false breakouts. Essentially, this is all they are, and you gain more experience by recognizing this in more chart time. Okay, and you'll be able to take advantage of these movements in the real market by recognizing the characteristics and the market behavior, noticing that the rejection is very strong, noticing the volume, noticing what time this is going on at. Is it near the start of a session? Is it near the close of a session? Is it breaking session, previous session highs or lows? You know, these are all very important questions you have to consider when taking trades, and what time you're trading as well. So now I know this video is false breakouts, buy traps and sell traps, and liquidity sweep. So we covered a little bit of the false breakouts and liquidity sweep. So now let's go to the buy traps and sell traps. So we're going to look at, here's an example I just made today, the lower time frame sell traps. Okay, so this is going to be a pretty good example here. So now if you're a day trader and scalper, this most likely has happened to you many times. So let's go over a few situations that happened this week on gold. So here we're looking at gold, where the current price action is. This is what happened this week. Okay, we have some important areas in price that we need to mark off right here. Another area of structure is right here and right here as well. Okay, now we can draw some supply and demand zones as well. That's your strategy. I use supply and demand, so I'm going to draw some zones here. And we have an area right here. And lastly, down here. So let's go over a few things, okay? One, I caught this trade, this sell trade right here on Friday. You go to the lower time frame, and I'm going to explain absolutely everything here. So this is where the sell traps come in, and then I'll explain where the buy traps come in as well. So first, we have lower time frame structure, right? You see that the overall trend is bullish, making higher highs and higher lows. We made a overall high, weekly high right here, monthly high until we broke higher, but right here, we see structure, higher highs and higher lows, right? So we made a high, boom, lower high, and came down to this low point, made another lower high, and then made a lower low down to the major low point. So I'm going to move this. This right here is what has just happened here, okay? I'm going to make where I have this current blue line here on the line chart. This blue line is right here on the line chart illustration, okay? Retest right here, right in this major. Here, I can draw this. Drag this down some. This is basically what happened. Had a nice lower high, came down to the lower time frame structure point, made a lower high, broke, retested, and continued lower, okay? That's exactly what happened. I took advantage of this opportunity right here, took sells when I saw the rejection. I noticed that it had to go down. I had my stop loss above this previous high, and turned on the rejection candle here, and sold at the major lows. Closed my position down here at 47.46 price range. 1747, yeah, 1747 price range. Right there. And this was the low for the day before it reversed and went higher, okay? So here's a few things you need to recognize and understand. One, people were assuming this was bearish based off the lower time frame, understanding lower highs and lower lows, right? But the higher time frame is bearish, and that's what the higher time frame is bullish, and that's what you need to pay attention to, as well as these major points of structure and support and resistance. Those are the main areas you need to be paying attention to because those are very important. It's where traders are planning to take their trades, where there's lots of orders, and where lots of decisions happen. They're make or break points, essentially. The market's going to reverse or continue from a lot of these areas. So right here, sells, boom. Now look at this little area right here in the ellipse, right here. We caught our first sell trade. We're looking at this ellipse right here. Okay, I'm going to go to a lower time frame. See an engulfing candle, a bullish engulfing candle on a level of support, a level of demand, and a strong area of structure. If this level were to break, this would be a break of structure, and the trend would most likely change directions. All right. So we have this lower time frame bullish candle. We see a bearish candle that failed to break the low and closes a doji. But on the lower time frame, check this out. There is so much good details right here. You can literally see the trap for yourself. So you're seeing lower highs and lower lows, right? See, this low is made. And if you're continuing with the trend, a scalper, and looking at the lower time frames, see this bearish candle, you're going to take a sell. And you can't say you wouldn't, because I know almost all of us have done this. I've done this so many times, you know, especially if I didn't even close this trade either. You know, if I'm trying to be greedy and think this level's going to break and target these lows, you know, or whatever. So you take a sell here and get taken out. This is a sell trap, all right? This just trapped the sellers in thinking, okay, bearish continuation, we're going to break the lows, break the structure, and go lower. But that didn't happen, because immediately we got a strong higher low point from this area, closed bullish, and broke through these highs and took the sellers out who had stop losses here, okay? There's other traders who had their stop losses above the previous high, a wider stop loss, because they know that this is the previous pointed structure, and if this point breaks right here, then it's going to continue higher. Okay, so I'm going to make this line, I'm going to add some text on it. This would be called a smart money concept trap. Okay, so after this movement, this bearish movement here, price comes back up to retest. If price is going to go lower from this point and make a new lower low point, it needs to from this point, needs to go down to here and break. If it makes a higher low point, like it did right here, if it makes a higher low point, this is not valid anymore. It's not going to go down. It's not going to go bearish. It needed to from here. If this is a valid double top, a valid lower high, it needs to make the push on this move, but it didn't. As you can see here, we'll zoom out. We created a higher low point. That right there is your signal that you need to get out of the market. You don't need to be in sells. You need to get out of the sells if you're already in the sells, depending where you got in. If you took the sells down here and you see price making a higher low, seeing a lot of low volume candles, low volume bearish candles. See, it's moving slowly. This was moving fast. These bearish candles moving fast. These bullish candles move pretty fast. Well, this bearish push, this pullback is very weak, low volume. It took 7 candles almost just to outdo one 15-minute candle. That's a lot of time. If it was going to go bearish, it wouldn't have taken that long. So what can we see here? Once you see that higher low point, let's say you're in the sell with some drawdown, you should definitely close, as this invalidated your trade. This could be called a change of character if you want, for those smart money concept people. So it's called a change of character because if it was going, like I just explained, if it's going to make a lower low and continue lower, it would have to make that push. But instead we made a higher low right here. Higher low right here. Okay, smart money concept traders are getting in, and break and retest traders are getting in right here, because in theory this is where it should continue from, and that's why we had a bearish push. You know, if you got in and took sells right there, there's nothing wrong. All you have to do is just manage your trade and manage your risk. You had 30 pips. That's a good little scalp. You know, I take trades like that. You just have to get out and think quickly and recognize if it's going against you, or recognize, you know, if something's not quite how it should be, you know, noticing the low volume, noticing that, okay, you know, it's kind of react from an area where a higher low could be made. Let's get out. And, you know, you could have secured your 20, 30, 20, 15 pips, however much, caught a little scalp. Just like that, and this is a good risk to reward. 2R risk to reward on this little scalp trade. Okay, so there's nothing wrong with taking those type of trades. It's just recognizing and managing your risk and trade management. But this is a smart money concept trap, because now traders who saw the rejection, are going, okay, now a lower high should come. This is what they're thinking. This is their thought process. They see this push. Okay, boom. Now we should go down, make a double top like that. But no, it's trapping the reversal traders and smart money concept traders here, because, like I said, in this context, it shouldn't have made this higher low. So in this context, it's a buy, and that can be recognized from the bullish volume candles as well. So you get to this area, you see a few candles of indecision, right? Looking like it's a sell. It's inducing these sellers, trying to trick you into thinking it's a sell, but it's not. It's a buy. This is a breakout trading strategy right here. This is a breakout trader's entry. So the buyers, this would be a great spot for an impulse entry or a breakout trade. If you miss the higher low point or miss the lows down here, this is a perfect spot for an impulse entry. In this context, these are good impulse entries and breakout trades. But when you do it too early and when the context isn't right and when the price action doesn't line up, it's a false breakout. It's a false move like I just showed previously. Okay, so now you see this move. You can either close at the higher time frame point of interest. And if you want a full breakdown on this, I literally just completely broke this down in the BAT playbook. This is one of the examples. This whole entire thing broken down in great detail. But you could close at this higher time frame point of interest where the previous highs were, and if you're anticipating a new higher high to be made on the day, then you could target, you know, the next potential point. And it'd be kind of hard to determine where that next point is in this area because we don't know necessarily where it is. Now it could be right here. If you had previous support and resistance marked up, this could be a good spot, but ultimately, I'm sorry, right down here. This could be a good spot right at 1665. That's where we rejected out previously. So if we go back, go to the lower time frame at the current area we were just at, what do we see? 1665 get hit, or basically get hit. Okay. Now you could add your take profits at 1665. It would have got hit later on, but if you're trading price action and, you know, scalping and going with momentum, then you recognize the exhaustion, you close. But as you can see, price never came back to where your entry point was, so you could have held all the way until your take profit because it eventually hit. You just had to be patient. So it really comes down to your trading style, but one can enter it again, noticing this higher low point and noticing that since a higher high was made, a higher low needs to be made, or should be made in theory, especially if it's a bullish trend. Structure was broken right here. This was a higher time frame break of structure. Made a higher high, so next should come a higher low, either from this point or from down here where it broke out from, where the entry point would have been these two areas from this little price range, from the area where it broke out from, or from the next area, which would be the previous resistance, now testing as support. So you could have caught multiple trades in this area of inducement / range, but it had lots of nice volume, so you could have definitely caught multiple different scalp trades, buys and sells. And one example of a sell that I lost because I got in a little too early. Okay, but this is an example of a buy trap. This is an example of a buy trap for breakout traders getting in too early. Okay, so this is the exact opposite example I was just showing. How here, where this was the right scenario for breakout traders for buys, and it was a sell trap for the sellers thinking it's going to go lower. This is the exact opposite. This is for buyers getting in thinking it's going to break out, but then it goes lower before it ends up going higher. Okay, similar to this had to go lower first before it ended up going higher. This had to go lower first before it could go higher. Okay, similar situation. So let's take a look. Remove that level there. I'm going to delete that as well, clean this up some. So here's a few things we need to look at. I'm going to draw the ellipse tool once again. Right here, this point. Okay. Now this area is very important. One, because let's back things up a bit. Remember when I said the session highs, session lows, and the timing of things matter. So let's take a look. Right here, this is the London session high for all Friday. Higher highs, higher lows. This was the highest point it made before New York opened. So after price makes a new high point, you should expect a pullback. A higher low needs to be created after a higher high. It happens literally every single time, or almost every single time. Sometimes the market just continues going and going, and you know, can't do anything about that. But in most conditions, there's going to be a decent pullback after a new high was created for the day. Okay, and it normally comes back to the point of interest that it broke out from, which it did at in this instance. So what do we see here? One, breakout traders are expecting this to go higher from this point. The impulse traders are expecting this. Okay, so we have this set up here. This is what they're looking at. They're going, okay, next candle, this candle should break higher or have a little pullback and then ultimately make a new higher high. They're expecting impulse move from right here. Stop loss could either be tight below the previous candle or below this low down here on the 15-minute candle. Now, obviously, we were taken out, right? Watch, let's go back. I'm going to go to the bar replay mode so you can see it a little bit yourself. So we're here. Okay, in real time, see this. Okay, yep, market's about to break. Market's about to break resistance, about to go higher. So impulse entry, impulse traders, breakout traders take the buy here, stop loss down here. It's a decent risk reward, 1 to 1.5 basically. That's a pretty good trade. And look what happens next. Rejection, false breakout, and we continue all the way lower, okay? Now, why did this happen from right here? Look what time it is. This is New York Open, 5:30, 6 o'clock. Okay, New York opens at 5, but this was the New York session high. Price is going to come back into the previous session highs to either have a liquidity sweep or respect them before it happens again. Something needs to happen before the overall move is going to happen, right? So the money needs to come from somewhere, and everyone is seeing this as a buy. It's not going to be a buy quite yet, especially given the time frame that it's at right at the start of New York session. If it's going to go up, it's going to happen later on in New York session after higher lows made like we have right here. Okay? So let's keep going. These buys are taken out, false breakout, right? Now, either buyers are thinking the buy is down here, right on this retest point, which it is. This is where the buy is, right where we got this rejection from. Nice reaction. The buys are right here. Okay? But there could be people now, traders now thinking, okay, it's a sell. Given the fact that, well, we just rejected, we made a triple top, right? A lot of people would be thinking this is triple top. I mean, look at it. It looks very bearish. So this time, sellers might be getting in. They either got in down here, and that's why there's strong reaction, or they're selling right here thinking it's a lower high point. Stop loss above there. Now, this is just for illustrative purposes and then targeting these lows, okay? So let's see what happens. Okay, good. It was working, right? The seller's like, yes, it's going, it's pushing. Then what happened? It flipped. Just trapped all the sellers in. It's bullish. See where I have this risk reward tool, the buy risk reward? That was the perfect entry. We caught the wick, we're in. But see, sellers were wrong here. This is not it. This is the wrong context for a sell. I mean, look, you got that bearish engulfing candle. This is literally what they're thinking. Okay? So what they're thinking. Oh, a little shooting star. Okay, we got to push. Oh, it's respecting this resistance area. Oh, strong bearish engulfing. All right, it's going down. We got our confirmation. But no, it just trapped you. Look at this. Higher low point. Lower time frame change of character. Higher low was formed. If it was going to go down from here, it needed to make this push. This candle would have never closed bullish. So if you took a sell here and you're in a small profit, get out when you recognize this. Or if you took a sell and you're in drawdown, get out before the stop loss is hit. Like literally close down here. You know, I know you have a good risk reward on these trades, but just close. This is wrong. Okay, look at the buy. If you would have taken the buy, look how clean of a setup this is. Look at your entry point. On point, right on the wicks. You would have sniped that. Okay, so in this context, you got to be thinking buys. Initially, it was a buy, yes. Right here, it's bullish, but it was not the time to go up yet. Okay, watch what happens now. Once price comes to this area, it breaks right through. Because it had to take liquidity first. It had to fake people out. Pull back again, making people think it was a sell. As you saw, that was a nice entry opportunity. Could have taken the trade again right on that wick. Targeting the same highs, same take profit. Could have the same stop loss if you wanted, or stop loss below the wick that you just entered on, or below this candle. You know, if you're already in the trade and it pushed bullish like that, your stop loss needs to be managed and move it up below that wick now, because if it's going to come back, it wouldn't go down there. Okay, so as it's going, it's pushing in your favor. Okay, that one would have almost taken you out. There might be another retest, but either way, you got to manage your trades and manage your risk appropriately. Okay. So yeah, depending how you manage this, you could have possibly got taken out. On this candle, you wouldn't have, because you know your stop loss is down here below this low. But if you got in on this entry point and you had your stop loss right below the wick, it would have taken you out. If you had it down here with the other trade, that would have been fine. You would have survived. But either way, keep going. And we ultimately end up pushing to take profit from here. We break the resistance and continue higher. Right to end of the day. This is how it closed. This is how it played out. We go up to a higher time frame. You can see just multiple wick rejections on the higher time frame here. Go to the 2 hour, 3 hour, 4 hour. Just lots of exhaustion. No candle bodies, just wicks. Price is building up liquidity to take off, and that's what happened. And if you go to lower time frames and understand structure and price action, you can clearly see these things, okay? But if you're looking too closely, it's going to try and trick you and fake you out, make you think different things are going to happen. They're going to make you think the wrong thing of what's really happening. You know, especially if you're looking at the 15-minute and seeing these bearish engulfing candles, you're going to think, oh, this is a lower high, it's going down. But it didn't. Okay? Everything's about context, everything's about timing. You got to know what time it is during what session you're in, where the highs and lows are for that day and the previous day and for the week. And you ultimately got to watch the price action and follow the order flow. It's a lot harder than I'm explaining it, but this is the exact process of what I do and what I try to teach, what I try to explain, and you got to watch out for these scenarios, okay? Because this is what the market does day in and day out, over and over and over. So a lot of times when you get in and take these buys, you're like, oh crap, got stopped out, and then later on it works, and then you're like, oh wow, I was right. You know, this happens over and over, and you can really start changing the game once you understand this stuff and put the time into study and recognize what's going on, recognize how prices need to move, recognize how the market needs to move, recognize what is driving the market and how and when and to where. You know, all that matters. You know, I know this went on for a little while. Either way, I hope you guys got a lot out of this, and don't forget to like, subscribe, follow the Instagrams, join Bat Signal's free Telegram channel, and I'll see you guys in the next video. Peace.